Yeah, welcome everybody to the ClearVista Financial Perspectives August 2024 market update. I'm Mark Trice, and with me in the studio today for this webinar is Jesse Hamilton.
Hey everybody, welcome.
We are financial advisors. Jesse, there's been a lot of stuff happening in the last 18 hours. This is August 1st, and the last 24 hours, we had a lot of activity in the markets, a lot of information being shared with us about the future of the economy and the future of interest rates in the Federal Reserve.
Yes.
So,
Not to mention that lots of things happened in July, and we're not going to talk specifically about that stuff, but it might impact the financial world. We'll get into all that.
All right, great. So, tell you what, Jesse, let's talk about our agenda today.
Sure. So today we'll discuss the performance of our indexes during the month of July, which will be just like we've done in the past. We'll look at our four major indexes. We'll make our comments on the markets and the current state of the economy. The Federal Reserve met yesterday, Mark, so we'll cover that press release in great detail. And then we'll talk about how this might impact you. And of course, as always, we would love to interact with you live. You can send your questions to info@clearvistafinancial.com, or the best way to do it is to text us. We have our phones right here.
I got mine somewhere.
254-282-0495. We'd be happy to answer your questions on the air. And if you're a little shy, then maybe wait till after the webinar. But that's the best way to communicate with us now or later.
Okay, Jesse, I'm going to go ahead and turn our camera off so participants can see our full screen.
Great.
With all the data we have there, and we will continue on. Let's jump in and talk about the S&P 500 this month.
Yes, so an interesting shift going on here. Just a reminder for anyone who's new, this is called a candle chart. Each candle is a trading day, and red candles are down days and green candles are up days. So the S&P 500 gained 1.12% in July, which seems mild month over month, but what really happened is some significant volatility and a nearly 5% pullback from the high to the low.
And really, that gain came yesterday.
Yes.
The last day of the month, investors were anticipating a potential rate cut in September, and we'll get into that in just a moment. But the markets liked the news a little bit. We're going to talk about what happened towards the end of the day.
They did. So you can see there on July 16th, we reached another all-time high, and then it proceeded to fall for the next 2 weeks. And like Mark said, it rebounded slightly towards the end of the month. It ended up positive on that last green candle of the month. But of course, that was a Fed decision day. So.
And this is typical in the summertime. Usually you have a lot of selling in late July, into August and early September. That's seasonal. Just because the traders are on vacation and things, and number of different reasons and things, but we weren't seeing anything that was unusual. We expect that kind of pullback, and what we're really going to talk about in just a minute is the rotation that's happening in the market now.
So here's the NASDAQ 100, which is our tech-heavy index, cap-weighted, does not have financial companies in it, and it's heavily influenced by those large companies that we've talked about. It tends to be a little more volatile than the S&P. The index closed down 0.76% in July, but you can also see that what happened on the last day of the month, it was up. The index reached a new high on July 10th, which is the first run up there on the green candles, and then it actually fell 8.87% over the next 2 weeks.
Yeah, and only yesterday did we have a really strong gap up in the markets.
Right.
I think the NASDAQ closed up, almost 3%, 2.6%.
Yeah, so without yesterday's action, the index would have down over 3% in July.
Right.
So that, like Mark said, this is a historic shift in the momentum for technology companies. This includes artificial intelligence and semiconductors. We're seeing a change here, but let's talk about small caps.
Okay.
This was very exciting. The small cap index was up 10.37% in July. So that's the largest monthly run up in 7 months. And you can go back up to 2 years before we see this kind of price action. But this helped close the gap we've been talking about between small and large caps.
That's right. Just closing the gap. We want to see small caps outperform large caps to indicate there's a lot more breadth in the market. And we're starting to see that shift.
Hmm.
And that was what was significant in the month of July, was seeing renewed strength in the small cap indexes.
That's right. So you can see the 4 trading days starting the week of July 8th through the 15th. There's so many gaps up where we had a space in between the prices and then a further green candle, which is a lot of momentum gaining in this index.
Right. Didn't close at an all-time high yesterday at the last day of the month. We'll have to see how the coming weeks and months play out for small caps.
Right. So lastly, of course, is the long-term treasury index. It was actually up 3.3% in July, which is good news, despite having some significant volatility. And if you remember, we've been sharing negative returns pretty much every month other than the last two this year. And we saw several gaps both up and down. This still tends to be a volatile index, and it will continue to be until we see some price stability for
Right.
interest rates.
Bonds are not, I mean, we always think of bonds being safe and so forth, and not always. Not in the last couple of years. We've seen a lot of volatility in bonds. In fact, those bond indexes are down quite a bit in that last 2 years. And really, the index would have been even higher had we not had a 31st day of the month.
Right.
Yields rose yesterday with the press release from the Federal Reserve. I don't know if long-term treasuries were anticipating that they were going to have a surprise cut yesterday, but they didn't, and yield rose throughout the day there.
Right.
Little disclaimer that we have to put on here. Take a moment to read that. That
Yeah,
these are just indexes. You can't go buy them or trade them. All right, Jason, let's look again a little closer at that gap or that difference in performances between the small caps and the large caps.
Yeah, this is exciting to show. We've been talking for about 2.5 years. This is a look back of that 2.5 years of how the blue line here is small caps and the green and red line is large caps. That's the Russell 2000 and the S&P 500. You can see how they track together for a while for most of 22 and 23, and then they split. And we have not seen the blue line recover back up to the large caps ever since the beginning or the spring of 2023.
Yeah, and that's significant. I was trying to annotate on the slides here, but I can't do it. You saw, in late December of last year, November, December, you saw that gap closing. Then we pulled apart in the early months of 2024. We're seeing that trend reverse a little bit and close that gap together. That's just a sign that perhaps we're seeing more breadth in the market. If Jesse's going to pull up on his computer T2107, which is an indicator we had.
It's on the slide.
It's on the slides? Okay, all right. We'll look at that in just a moment. But yeah, this is a good sign that there's more breadth in the market. Will that trend continue? We don't know. There's a lot of volatility today in the market indexes today. A little bit of profit taking, if you will, from yesterday's announcements about interest rates and things. So,
well, Mark, we talked about this happening one of two ways. Either the large caps lose big time and the small caps stay steady, or the small caps take off. And luckily this month or last month, we saw the better of those two, which is where small caps take off.
Yeah, so something to continue to watch, because we want to continue to see that breadth develop in the market.
So here's the same data looked at in a different way. I want you to focus on the black line here. When the black line goes up, large caps are outperforming. And when it goes down, the small caps are outperforming. You can see the general trend, other than November and December of last year, is up. But then look what happened in July. A dramatic shift towards the downside, which means the small caps significantly outperformed. And this is good news.
Yeah, and we'll see if this trend continues. I know there's a lot of semiconductor and artificial intelligence companies that are reporting earnings. Yeah, both yesterday and today. We'll see if that trend reverses itself or continues where small caps are the dominant sector here for now.
Right. It'll take many more months of this pattern to assure long-lasting market breadth, but it is a move in the right direction.
Okay, great.
This is what you were talking about,
Oh,
Mark. This is
my measure of percentage of stocks that are trading above their 200-day moving average, and that indicator as of yesterday is what?
60,
Because I don't have my glasses on.
63%.
Okay, so we're above 60 again. That's
We're
that's a
above
sign
60.
of momentum changing and improving a little bit, and we like to see that maintained for some while. We haven't been above 60 since really April, and we want to see that continue to maintain this level, if not even go higher.
Yeah, we've struggled to get above 66% this year. And just to be plain and simple, this is a measure of strength in the market. So if this can reach 70, then we have confidence that this is an even stronger bull market condition.
Yeah. Now, we are, Jesse, about to go into a period of volatility.
Yes.
Seasonal volatility. We typically will see a lot of volatility in the months of really the end of July through the end of October.
Yeah.
This little chart here is showing what we call the VIX. It's a measurement of volatility in the market. This is a seasonality chart that we got from equityclock.com, and it shows that volatility increases in the months of August, September, and October, and then falls typically throughout the remainder of the year. However, this kind of time could be different. We kind of anticipate it, so we tend to be prepared to take defensive action on our client portfolios. However, this is typically a good seasonal time that we see volatility increase, and that volatility is a measure of how much movement we see in prices in individual securities or ETFs in the market.
This is not a historical average of the S&P. It doesn't mean the prices are going to go up in the fall. It just means that historically we will have an increased amount of volatility.
And sometimes you usually see that the month of August and September is a flat or down month, but that doesn't mean that's what happened this year. We're just looking at patterns here, and we expect volatility, especially since there's talk of the Fed cutting interest rates sometime in the future. We'll get into that in just a moment.
Here's our grid that we've been showing for the past few months about our different indexes. So before we make a shift here in a moment to the macroeconomic environment, I want to explain what's going on. The NASDAQ year to date is positive 17%, which is very strong. And you might ask why my portfolio is not doing that. It's because you don't own 100% tech companies, because they could swing minus 17% like that.
Yeah, and hopefully you don't. If that's the case for you, you need to talk to an advisor or financial professional that can help you diversify your portfolio.
But the S&P and the NASDAQ have recovered this year. The long-term Treasury index is down 4.09% from the beginning of the year, but the really challenging part, Mark, is it's still down over 40% since its high.
That's right. And so many investors that are especially approaching retirement, they'll hold a significant portion of their portfolio in long-term treasuries. And that's concerning, especially when you think they're safe investments. You want to make sure that you're watching that, make sure you may not, to talk to a professional about whether or not you need to make adjustments in your portfolio.
That's right. So we cover the moderate portfolio index as one of our benchmarks. That's up about 5.08% this year, which is strong. We'd love to see that continue on that trend. But what's still difficult for a lot of investors is it's down 5.3 since its high. So we're talking about all-time highs in the equity indexes for the S&P and NASDAQ, and people wonder why they still are not back to that point.
The moderate risk tolerance investor is struggling. They're struggling to see why they're not making 17% returns this year. And they are up a little bit because bonds have improved somewhat, but still this index has not recovered since its high in November of 21.
That's right. And then the S&P equal weight, where each company has an equal say, is up 8.75, which is increasing the market breadth.
Yeah, and that's a signal of that, and we'd like to see that improve.
So here are the Magnificent Seven, and I blocked out the tickers for compliance reasons.
We're not allowed to talk about those things.
No, but you all know these companies. They're the ones that build our phones and our computers and our microchips and deliver things to our doorstep on a day's notice. But this group's leadership over the past 18 months has been historic. That's why they got the nickname Mag 7. But they've declined significantly since July 10th. So I added up all the market cap loss from July 10th until 2 days ago, and it equates to $2.6 trillion.
And so that's quite significant, because that is a big move down. We saw a lot of volatility in these.
Mm-hmm.
There was some concern that maybe the artificial intelligence buzz was fading and things of that nature. But we're starting to see some quarterly reports come out for some of those companies, and
Mm-hmm.
so far they've been somewhat positive. So we'll have to continue to monitor that and see if the Magnificent Seven will continue to ride.
Right.
Throwing reference to the 1960 Magnificent Seven movie, of course.
A lot of investors have been overweight into this sector, and we just wanted to bring up the significant market cap loss.
If you can tolerate the roller coaster, then maybe that's for you, but most investors do not like to see volatility like that.
Yes. So, reminder to our listeners right now, we'd love to connect with you live on the air through text 254 282 0495. And you can do that now or later. But, Mark, let's talk about the economy and the interest rate environment. We always want to gain perspective. So, let's talk about what happened yesterday.
Yeah, Uncle Jerome. Uncle Jerome spoke and delivered the results of a press release from the Federal Reserve meeting the last few days. They decided to hold rates steady.
Mm-hmm.
They did in their press release. There's a little bit more dovish tone in the press release. We compare the past press release to the current press release
Mm-hmm.
to see what words have changed. I know you have to be an English major to kind of figure some of these things out, but they agreed that economic and inflationary progress had been made and time is coming to potentially reduce policy restrictions.
Mm-hmm.
Now, depending on what headline you read, it either says
rainbows and sunshine,
rainbows and sunshine, or we've got a little more work. But what happened is that, we're seeing the labor market is just now recovering to pre-pandemic levels. Can you believe that? Pre-pandemic levels. And that took over 5 years to happen, almost
Mm-hmm.
5 years to happen. But Chairman Powell did lay the groundwork for potentially a September rate cut during the September meetings, which we'll be watching very closely. But he did talk about leaving him some room here because they want to see data. A lot of people, and when we were watching the questions and so forth in the
Mm-hmm.
press conference, and a lot of people are like, why can't you cut it now? And I think reporters often think that the Fed has a crystal ball. They could cut it now, but they would be guessing.
Right.
And economists don't guess. They rely on facts and data. They might make forecasts and so forth, but they don't guess. And that's something that you have to remember. It's very much a judgment call. And it's very difficult to call. I don't envy the Federal Reserve's decision making, but the decision to keep rates steady, no changes, was unanimous amongst all voting members. But he did speak with a more of a dovish tone, where suggesting that there might be a soft landing in the economy and so forth.
They always try to pry it out of him. So the statement is an official recording of the meeting, and then then people asking the questions to him try to pry more information, and that's where the more dovish tone came from.
Right, and we're going to get more data between now and middle of September to guide the Fed in their decision. We already saw predictions of unemployment rates creep up a little bit, and I don't remember what the measure was, but you have to remember that a 4% unemployment rate is really considered full employment in the United States. If it's less than that, that means there's a major shortage of labor. If it's more than that, then perhaps we're seeing the labor market slow down.
Mm-hmm.
But we're not seeing a dramatic change in the labor market that would suggest that hiring has stalled. So the comments initially pushed the market higher. They were excited, but by the end of the day, they began to sell off again, and they're selling off this morning as well.
We see that almost every time.
Yeah, it happens. You see a reversal the next day. So we don't, we've always made decisions that we're not going to take action the day of a Federal Reserve press conference.
Yes.
And we usually wait a day or so to make any moves in the portfolios if we need to, because we want to let the the swashbuckling, if you will, feed through investors and settle down a little bit.
Our patience tends to pay off.
Yes, it does. Okay. So this chart shows the length of time historically that rates have been held at a high. Now you can see the current rate cycle shows about 12 months of rates held at that 5.25 to 5.5%.
It's a long time.
Yeah, and this is only taught by the 2006 and 2007 rate hike cycle. Now, we all remember what came after 2007. There was 2008 and 9. So we hope that the Federal Reserve is, I mean, we know that they're aware of these things. They're trying to make sure that they don't wait too late for a cut, but they also want to do it prematurely because that can cause just as much calamity in the economy as going too early or too late.
You talked about not envying their decision. I saw this next article talking about how these high rates have really affected families across the United States. And it's a huge impactful part for us. So in the year, it has been a year, 12 months since the interest rates were at a 2-decade high. The central bank has succeeded in taking the steam off of maybe a heated economy and lowering that inflation over time. But this means that higher borrowing costs are affecting you and I and the average American.
Yeah, and that's, a lot of people are not, I was listening to Bloomberg this morning, and a lot of people, I mean, they don't want to sell their house because they've got an interest rate below 3%.
Right.
And I think it was 6.58 was the national average this week for a new home. And that's a tremendous amount of increased cost if you're financing a home.
That's right.
But that year of high interest rates, and unemployment's inched higher, but inched, not something dramatic. We are, Jesse, remind me of that index that's about to tip over, depending on the REAM or the ROM index.
SOM index.
SOM index. Thank you. The SOM index, which says that, if it tips over a certain ratio, which it could tomorrow when they release unemployment numbers, there's a good chance that unemployment will increase.
100% historical success.
Yeah, I mean, but they also told us that inverted yield curves lead to a recession within 12 months. It hadn't happened. So this time is probably different. We just watch the data and respond to what we're seeing.
Here's the inflation progress, and you can see the high in mid-2022, which, of course,
around 7%.
Around 7%. And the presidential administration likes to tout that it's going so far down and all this amazing progress. It's still significantly above the 2% target.
The notion is inflation is falling. Well, inflation's not falling. That would indicate deflation. We're not seeing that. Inflation is well above the 2% level. It's about 2.5% is where it is as of last month. But we're still seeing prices increase.
Yes. So here's some job market information. The U.S. jobs market, which bucked expectations of a slowdown time and time again, despite these high rates that we've talked about, it's showing signs of cooling, which is positive for the Federal Reserve. Hiring has slowed from overheated levels that we saw 2 years ago, and companies are posting fewer job openings.
Yeah, and the unemployment rate, which comes out on the 2nd of August, will determine how we're doing, and if that's really happening. That's an increasing unemployment rate would indicate to the Fed that that's the economy is cooling. Maybe it's okay to go ahead and cut rates.
Good news is bad news for them, right?
That's right. So the rate hikes over the last year or so have had the clearest impact on the U.S. housing market. We mentioned this earlier, and it just spurred a surge in borrowing costs, but also a run up in home prices because there's fewer people selling their houses.
Right.
And there's still, and it's interesting because I was listening to a report on the housing market around the country. It's very much geographically centered. You're still seeing prices increase in places like California. The majority of building that's going on is actually happening in the South and Southeast. And they're actually seeing prices levelize or stabilize, if you will, And so that's a sign that they're being they're keeping up with demand and things, but we're still going to see those rates hover up high for some time. You know, a rate hovering around 7%, the monthly mortgage payment on an average median price home climbed about to $2,291 a month, and that's up from $1,205 a month 3 years ago. This is, of course, according to the National Association of Realtors.
Yes.
So quite significant.
Here's the official consumer price index data that we got for June. It came in softer than expected. This is a little bit older data, but it's still relevant.
It's a couple weeks old. That's
Yeah.
it. But the CPI declined 0.1% in June. This is where you're going to hear all the political pundits come out and say that inflation's falling.
Yes.
But the CPI is still up 3% from a year ago. We look at rolling averages, 12-month averages. CPI is up 3%. And then the real one, the core CPI, which excludes the volatile food and energy categories, it actually rose 0.1% in June. That was below what consensus predictions were by economists, but that still is rising. But this is still giving more data to the Federal Reserve to say, hey, inflation is being tamed. We are moving in the right direction. But we all remember, probably if you're old enough to remember, the late 70s and early 80s where inflation took off, and it was because we didn't hold interest rates high enough for long enough.
That was double-digit inflation.
It was, and especially on the second of that, the Fed cut rates too soon, and we saw that inflation take off again. Yes. So, all right.
We also got GDP data.
Yeah, and positive data for the GDP. And this is the conundrum a lot, right? Because okay, if we're not really we're seeing the economy slow in certain areas, but not all areas. Real GDP grew at 2.8%, an annualized rate in the second quarter, and we were expecting around 2%. Most of that growth was accounted for by an increase in consumer spending, which grew at a 2.3% annualized rate. So, but the largest surprise in all this was there was a big increase in business investment in equipment, which grew at an annualized pace of 11.6%. And that's likely what we think is a lot of companies that are investing in artificial intelligence. There was a big wave in the beginning of the year. We're still seeing that play out. But that core GDP increased at a pretty healthy rate of 2.6% and is up almost 3% from a year ago. But, not all this was good news, right?
Net exports were low.
Right, and that was created a little bit of a drag on the growth rate. Imports surged. That's partially due what reporters think is importers trying to get ahead of a possible dock worker strike later this year, and in turn that likely led to a surge in import activity for that. But we've got moderate growth, economic growth, a little bit of decelerating inflation. And so a lot of people think the economy's in the clear without any trouble ahead.
Well, taking a really high level view at it, though, when inflation is pacing similar to GDP growth, you're in a good spot, right?
Yeah, for the most part. All right, so high interest rates are still affecting Americans. We've talked about this many times. Just because the Fed might cut interest rates in September does not mean that's a big positive for the market.
Yes. So
in fact, we see more volatility when interest rates are falling in the market. Tends to be sometimes better for small cap companies than it does large cap companies, but still a lot of volatility.
Here's the Treasury yield curve as of the end of July, and it's relatively unchanged, still inverted. We're at 2.5 years of an inverted yield curve. You mentioned this earlier, but that's historically proven to lead to a recession. Doesn't guarantee anything, but it's happened every other time in history.
How long have we had an inverted yield curve?
2.5 years.
2.5 years, yeah. So that's a good while. I don't see how this is going to correct without having a little volatility in the market. But you're still seeing those 1 month yields just below 5.5%. That's why you can probably pick up a couple of CDs of very short durations at your local bank or credit union that are paying a decent yield. All right, but this doesn't predict the future. It's just a signal that we look at that
That's
says,
right.
pay attention, make sure that you're watching your portfolios.
Here's the 10-year Treasury Index, which is probably the indicator that most directly affects American borrowers. And this goes all the way back to 2020. I wanted to show a long-term perspective of what the 10-year yield is doing. Um, Back when COVID was happening, we were at almost 0%,
Right.
which is incredibly liquid environment for people to borrow money. And the scale on here, it's really small, is 1 decimal point off. So we're at 4.109 as of yesterday's close. But I just wanted to show how quickly it's risen in 4 years. This is directly affecting borrowers.
That's right. And we don't see that falling anytime really soon. Even if there's a quarter point interest rate cut in September, it'll take some time to see that. I think in my mind that we've already seen the possibility of an interest rate cut in September flow through the markets. That anticipation's already been factored into the pricing.
So we don't get into politics here, but it has been a memorable month. We saw several things happen across our country, and I don't know if we want to go into any details on what.
But what I hear is that Walter Mondale is now running for president.
I didn't know that.
You don't even know who Walter Mondale is because you weren't alive. Walter Mondale ran against Reagan in 1984. And of course Reagan won in a landslide, won almost every state in the union.
That the polls showed that Reagan had like 98% approval.
Yeah. So anyway, no, we saw, as you probably are well aware, President Biden dropped out of the race. He was forced out. They made him an offer he could not refuse, and who knows what that means. But I'm guessing it maybe is immunity from prosecution in the future. I don't know. And we're not making opinions about those things, but it has made the outcome of the November election a little bit more uncertain.
Yes.
So yeah, okay, we can get polarized in our opinions about different things, but as financial advisors, we want to respond to the data, not the headlines. I mean, it's so many times. That's one of the first things that I learned, Jesse, is becoming a financial advisor is don't read the headlines.
Right.
Because the headlines don't tell the true underlying story. So we've shared this before, but this shows you U.S. stock performance every year, every election year going back to 1928. And there's only been 4 years in which we saw a down market. And most of those 4 situations, in fact, all of them, there was a greater financial crisis that was going on that was impacting the economy, not the presidential. The presidential election was not having a big impact on that.
Yes.
So, our strategy doesn't change for our clients based on who gets elected. I know it's a question we get often, right?
At almost every single meeting, we say, if so-and-so is in office, then we're for bull markets for 4 years, right?
Right. And some people will say, please pull all my money out because so-and-so is going to get elected.
Yeah.
It doesn't matter. The market will move the way it wants to based on the strength of the economy, based on the fundamentals that every public company is trading at, and what's going on around the globe. So all those things do matter, but they don't matter from the standpoint of you should not be making financial decisions based on who's in office or potentially going to be in office later on.
That's right.
All right. So how does all this impact you? Still lots of conflicting economic data. I mean, our job would be a whole lot easier if everything was rosy and picture perfect. But you probably wouldn't need us either. So what does it mean for you? Well, we just don't have a crystal ball about the future, but we do know that many of these conditions we talked about, there's still a possibility of a recession. There's still a possibility that the market will continue up towards the end of the year. We just see a breaking news item there. Looks like the United States traded for Evan Gershis, the Wall Street Journal reporter who's been in jail in Russia for some time. We'll find out what the United States had to swap for. But let's talk about our strategy a little bit, and we'll wrap up today.
Still the things that are affecting the listeners on this program right now. Inflation is still above that 2% target. We do have increasing market breadth, and that's a positive thing for our investors. The bond indexes have not recovered. That's going to be heavily influenced by the interest rate decisions in September and moving forward. And we've seen credit card debt has not gone down at all. In fact, it's at all-time high. Personal money supply, so actual cash in people's hands, is at an all-time, not all-time low, but recent low for sure.
It is falling, yes.
And of course, election season brings immense anxiety to investors. So we recognize that. We want to say that we hear you because it's all over our world right now.
But guess what? We've seen this before.
Yeah.
We don't know exactly what will happen, but we do know that there will be certain things that happen in the economy and the markets with every new administration. But that's not how we manage our clients' portfolios. So the big question everybody wants to know is, as we're adapting to this dramatic shift, and one reason we choose to manage your investments with technical analysis and active risk management is because the traditional buy and hold model is probably not the best way to go. It is a way to go, but we've seen certainly over the last decade that approach has ended up costing investors potentially money. So as the indexes continue to rise, we'll take advantage of any opportunities the markets present. And that's the key. Use momentum of the individual components and sectors of the market to balance your portfolio in a way that will allow you to make money in different situations, not all situations. So we encourage our listeners, Jesse, to avoid that panic. Don't make decisions based on headlines, or certainly don't make decisions based on emotion. It feels really natural to react to things, and that often leads us to make irrational decisions.
That's right. Like investing whether or not a certain person is in office.
Right. And we still believe that the U.S. future is relatively bright. The economy will continue. The economy will continue to operate no matter who's elected, whether there's a recession or not a recession. All these impact us individually and separately, but still we think there's a lot of positive things that are going on.
Mm-hmm. So we don't always throw this slide in. A lot of people have a majority of their net worth, if they've been working, saved up in a retirement plan. If you have a 401k and you have not logged in and chosen the investments based on your strategy, we can help with that. We have a new tool that will apply to any 401k plan in the whole country, big or small. And we'd love to offer that to you by listening today. We'll give you that as a part of participating. And we can help you make some decisions about your specific tolerance.
There was an article in the Wall Street Journal this week, and I wish I remember the title of it, but it was talking about how many 401k investors are still invested in a money market.
Wow.
From going back to 2022 or even later. Folks, that's
Ouch.
costing you not looking at your portfolio may be costing you thousands of dollars of retirement money, future retirement money. So I encourage you, if you haven't looked at your 401k in a while, give us a call. We'll help you take a look at it. We'll help you make sense of it. And because you're listening today, we don't charge anything for that consultation, but we encourage you to take advantage of that opportunity, because you do not want to sit on the sidelines and realize woulda, coulda, shoulda, right?
Right.
We don't want that. So, man, we made it to August. It's just now getting hot in Central Texas. I'm thankful that we haven't set any records for 100-degree days this year.
Yeah, it's been pretty mild, which is great.
Doesn't look like we're going to get there with that, and I don't mind that at all. So just remember that we can offer you some help if you just want to talk to someone about your situation, see if you're on track for that goal that you're planning for. As always, we want to encourage you to check your financial statements, look at your strategy, revisit with your current financial advisor. If you don't have one, we'd be happy to talk to you. I was looking.
We got a good question while we were waiting here.
Okay, yeah. Here we go.
If we're planning on the Fed cutting in September, should I go ahead and lock in CD rates now if they're going to change?
Let me consult the magic 8-ball. No, I'm teasing. The question is, and a lot of people are looking at this, we're looking at certain types of financial instruments that lock in those higher rates. There are things other than CDs that you can use as a tool in that. If you're interested in those things, give us a call. I am seeing, and we do a scan with like bankrate.com. That's a good one to look at CD rates, and they're still in the 4.5%, maybe close to 5% rates, but they're all short-term CDs. So I suspect those rates will fall soon in September, but don't think it's going to be a lockstep decrease. For example, if they cut it 0.25%, which is what we're anticipating at the Fed data, the data they need and see gets positive for that decision, I think you'll see CD rates fall even more than 0.25%. But because I think if they cut once, they've got to cut 2 or 3 times in order to make an impact and spur growth.
It also takes time for that to trickle down to the banking system.
It does.
You're not going to show up the next day after Chairman Powell speaks and it's cut.
But the reason that you're still not seeing, high 5.5, 2-year CDs anymore is because no one in the banking industry expects these rates to stay high.
Mm-hmm.
Now they've been higher than longer, but if you're a CD investor or holder and you're coming up on a renewal and that's something you want to keep in your portfolio, yeah, go ahead and try to lock in the higher rate. You're not going to get more than 7 months or maybe 13 months locked at that higher interest rate. There are other alternatives to lock in that rate or higher rates for a longer period of time. We always encourage people to look at that as an alternative CDs. Give us a call in our office. Those numbers again are 254-282-0495. You can also visit us on the web at clearvistafinancial.com. And if you need to, send us an email, info@clearvistafinancial.com. Jesse, I don't see any more questions on the board, do you?
I don't think so, but
hey,
they're very available if you want to text us.
That's right. That's an easiest way to contact our office, or you can even schedule an appointment on using our Calendly link that you can get with a phone call on there real quick and stuff. Well, folks, Jesse, this has been an exciting month to see a lot of transformation, a lot of shifting going on and rotation in the market, a lot of new variables that are in play now, given the changes in the presidential candidates, given the indications of the Federal Reserve that maybe possibly, if the data shows to support that, there might be a beginning of rate cuts in September. So all these things are relevant. All these things are important. And we'll continue to watch those things. If you have questions, feel free to give us a call. Until next time, we thank you for listening to our program and joining us this month. We'll talk to you again in early September on the next ClearVista Financial Market Updates. Have a wonderful day, and we'll talk to you soon.